Welcome to Investor's Guide. You're watching ET Now. Thank you so much for joining us. Now, this is a show that helps you sift through the entire market and find investment products that suit you best. This week, we're taking a very close look at gold. We've been getting a lot of questions from viewers about the fact that gold has moved up about 7% in 2014. Everybody wants to know if 2014 is going to be a better year for gold than it was last year, and how you should use it in your portfolio. I have two wonderful guests joining me in the studio. There's Ashok Mittal, who is the CEO of Emkay Commodities, and Gaurav Mashruwala. We all know, we are familiar with him on the show. Both of you, thank you so much for coming in. Now, if you have questions about gold, our email ID is on your screen right now. Send us any question you might have about gold, and it'll be our pleasure to answer your questions on this show. Now, first, before we talk to both of our guests of where gold is headed this year, take a look at the last 1 year. It's been very choppy. There's been a lot of policy decisions made about gold. There's a lot of things that have affected the price of gold. Take a look at that quick recap, and then we'll come back and talk about it.
Let's be honest, in India, we like our gold. But for those of us who have always relied on gold as an investment, 2013 was a rough year. And here is what happened. The global price of gold crashed 28% on concerns over Fed tapering its stimulus. But in India, that crash was cushioned by the falling rupee and measures taken by our government to curb the demand for gold. The government hiked import duty of the yellow metal by 10%, artificially increasing the price by 15%. As a result, the domestic price of gold fell 13% last year. The hard measures worked. In January this year, gold imports fell 77%, which may suggest the Indian buyer has not taken a sheen to gold this year. And analysts agree that even though gold prices were up 7% in 2014 so far, they tell us it's only temporary. So if the government rolls back its import curbs, the price will automatically be brought down. So should you shop now or wait for a better rate? Let's find out.
All right, so that was the price of gold. Ashok, I'm going to come to you first. So much happened over 2013, both globally and domestically, like we just heard. But it does seem like people are slightly more optimistic about gold in the first month or so of this year. We've moved up 7%. But that doesn't mean the fundamentals have changed. We could still have a bad year on gold, couldn't we?
In fact, the outlook for the gold for the whole year is not really very positive, because we expect gold to remain under pressure because of various fundamental reasons. One of them, US continue to taper the QEs, so that means the liquidity will be lesser. We have also not seen any increase in the ETFs globally, in gold ETFs. So Indian demand is lesser because of restrictions being put there. So net, we don't see any reason that there will be drastic demand in gold in this year. So hence the prices will remain under pressure. Broadly, the whole year outlook, if we take, we expect gold to remain between $1,200 to $1,350 on the international market. So
what does that mean for us here in India? If you're saying, that's the price in the international market as you expect
I think
it to
in
be.
rupee terms, we see somewhere around 27,000 to 30,000 rupees as a range. So we are closely right now around 29,000 rupees for per 10 gram. So the idea will be either you wait till it goes to say $1,200. That effectively means maybe another $70, $80 down from the current level. So you see a fair correction happening from the current price. Or you really don't look to invest in gold till the time you see those kind of levels coming. Current levels are not really good levels being suggested by most of us to invest in gold.
All right, so if I've understood that correctly, do not buy gold at these current levels. That's what you're saying. And if we go back to the fact that the government might be at this point considering removing those import duty measures that were put on gold last year, will that bring the price down automatically?
So what happens is if the government is removing the, say, restrictions, but it's also important whether they are going to reduce the duty, because now there's a high amount of duty being levied on gold prices. So we need to consider in two aspects: whether internationally price will go up, looking that India is going to import more, yes. But at the same time, if the duty is reduced, that means the price in India, the retail price in India will actually come down because of the lower duty. That duty is quite high.
All right. So, see, a lot of the viewers who write in to us are looking to buy gold for a slightly longer term. And I know from where you're looking at it, I'm going to ask you to do something which is close to impossible. You just gave us the 1 year view. Give us the 5 year view. Now, is gold going to continue to beat inflation? It didn't last year, but it has over the long run. Is it going to continue to do that, or is that fundamental use of gold also in jeopardy at this point?
Now, it depends what you want to do. If you're really a consumer, because mostly we see people investing in gold or buying gold for their consumption, for marriage purpose and all. On a long-term perspective, whether 5 years, 7 years, 10 years, it is always good to invest in gold, because everyone want to have this as a safe haven currency in terms of investment. And on a longer period, it definitely beats the inflation. But it is also for the consumption purpose. Now, if you are looking for investment purpose, right? So then you try to time the market in terms of prices. But then again, you can't really do it. So the way we do investment in equities by SIP, I think similar way the gold investment plan, GIP, you should be doing, and that's the best way to invest in gold because you can't really time the market from price perspective.
All right, so what you're saying right now is don't put a lot of money into gold right now. This is not the price to be buying gold. If you're a long-term investor, then it makes sense to put a little bit every month like we do in an SIP. Gaurav, for those of us who are long-term investors, if we are like, Ashok was just telling us, if we are at some point going to buy gold for a wedding, a daughter's wedding, which is 10 years down the line, then it does make sense. But as an investment on the price, do you think we'd be better off in fixed deposits and equity and avoiding gold given where it is right now?
No. So, Faye, if you look at a portfolio which should be diversified, so it should have various asset classes. You'll have equity as an asset class, you'll have debt as an asset class. And to that extent, gold as an asset class is something that you should be having. I mean, ignoring a particular asset class because it hasn't performed well or it is not likely to perform well is looking at just one piece in isolation. That's not the way you construct a portfolio. So you may reduce or increase the quantum based on your financial goals and the overall composition of the portfolio, but ignoring it completely is not very prudent to do.
So give us a cap. I mean, let's also talk to our female viewers, and I love talking to our female viewers. A lot of us find a certain comfort in buying jewelry and locking it up because it's something you can take and run. It has automatic value. We've locked it up. We can touch it. We can feel it. We know that it's there. Why should we differentiate between consumption jewelry and an investment in gold, and how are those two things different?
So when we use it for consumption, a lot of emotions are attached. So if you have, say, for example, gold necklace or gold earring, and the price of gold go up or go down, you're not going to sell off one earring or knock off half the necklace. It doesn't mean you don't purchase gold. So I don't want any women coming and kind of, you're saying, I'm not against. Please pick it up if you like it and if you enjoy and look pretty. But if it's from investment perspective, you would be able to take rebalancing calls. You'd be comfortable liquidating it. To that extent, have that clarity in mind that gold, which is for self-consumption, is not really an investment. And gold, which is for investments, is not what you make jewelry out of. Having said that, there could be certain situations. For example, what Ashok discussed earlier was that you're probably picking it up for daughter's jewelry marriage at a later date. In that case, keep doing it from investment perspective, and at a later date, nearer to marriage, liquidate that and purchase jewelry. So then the investment will change to self-consumption.
I have a question for both of you. Give us a cap that we should have in our portfolios for gold as an asset class. So if I have 100 rupees, I'm splitting it between equity and debt and gold. What should that gold allocation be?
So since now the outlook is not really so much higher, or we are expecting a higher return, which we have been seeing in the last, say, 5-7 years. So the percentage, I think, has reduced now. So in current scenario, I think it will be around 15 to 20%.
How about you, Gaurav?
So again, for me being a planner, it will be more gold-based and when do you really require. But if it's 20 years, 10 to 15% of gold in your portfolio, so it's more or less kind of same range.
How often would you like us to visit that allocation? Should I look at it once a year and say, okay, the outlook is not very good, so I should bring down my exposure to gold or something like that?
You may not be churning your portfolio, but you may still want to keep track on quarterly basis. So it doesn't mean that at the end of a quarter, if prices have really gone up or really go down, you either liquidate or purchase more or whatever, but at least keep an eye on it. So it shouldn't happen that at the end of the year, suddenly you realize that, oh, from the overall valuation, this is 25% down or 40% up or whatever, though I'm sure, we don't see that kind of range. But once every quarter, revisit your overall portfolio and at least keep a track on what's happening. Doesn't mean you're buying and selling.
All right. We have a couple of questions, and this one's important. Muthu has written in from Tamil Nadu. He invested 2 lakh rupees in e-gold and e-silver. He wants to know now what the future of his investment is. Of course, we all know the money is blocked until that whole mess is sorted out, and it's sub judice right now. The court has to decide what happens, and then the money will be returned to investors. For the thousands of investors who are watching right now, like Muthu, and the big concern here is, even if he is going to get his money back, it's not earning anything right now. It's just locked up. Tell him what he can expect and tell him what the procedure is.
See, I think it's as you said, not about Muthu, it's about thousands of people. But there is a good news because the forensic report has come. So now FMC will be submitting the court, and we, in all likelihood, are expecting that court will give the decision that this money should be returned to the e-gold, e-series investors. So effectively, they will get the money back.
By when?
So,
when can we
expect that this process should be over in about, say, 4 weeks' time. So that means around 1 month from now, they should be able to get the money if there is no other hiccup, no other court case, or no other problem, which we are not expecting right now. So if that happens, then exchange has set up the process, how it will happen. So exchange will be opening a window where they will be selling this gold, which is lying with the exchange, and then returning money to the clients.
And will that be at the daily price of when that happens?
Yes. So there will be price given there, and we expect that their price will be around 2% lower than the current ongoing market price. But I will say still it is good because thankfully gold price has not really crashed too much. So say they are still around, say, 29,000 rupees. So although it's not earning, but thankfully they are not going to lose so much of money. So I think around 1 month time they should be able to get their money back.
So it's going to be 2% lower than the market price on that day. He will still have to pay tax on any sort of return he makes on that sale, wouldn't he?
Yeah, if there are capital gains, then they have to pay the capital gains.
All right. So Muthu and any other investor who's a little disappointed with that gold or the spot exchange investment that you made, the good news is you will get your money back. The bad news is it might be on the daily price, a little lower than the daily price. Plus, you'll have to pay tax on any money that you earn on that sale. Also, that option now is forever closed for investors. That brings down the options that we have if we want to invest in gold.
Yeah, all those people who thought that they will be able to invest in E-series of gold, silver, or NSCL. Now NSCL is not functioning, so there's no fresh investment they can make in that mode. They can invest in MCX or NCDX, the commodity exchanges. They can do ETFs, they can buy gold bars, and all other options are available except this NSCL.
All right, we're going to go into a very quick break, but when we come back, we will talk about those options that were just listed out, and we'll tell you which one is the most efficient for you out of ETFs, fund of funds, actually buying physical gold. Which one should you do if you're investing in gold? That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide in ET Now. This is our gold special episode. In the studio with me, Gaurav Mashruwala, Certified Financial Planner, and Ashok Mittal, CEO of Emkay Commodities. Gentlemen, thank you for staying with us. Before we went into break, we talked about the fact that there are different options. One less than we had last year, but there are still different options for those of us who want to invest in gold for the long term. I want to take the same example. Someone watching at home who's putting money away for a wedding in the future, or someone who's adding gold to their portfolio for the long term. Out of all the options available in the market, I want each of you to tell us which one do you think is the most efficient and which one you recommend to long-term investors.
So let us say there are 3 kind of options which are available. One, you can trade on these commodity exchanges and take deliveries, MCX or NCDX. Second is you can buy physical gold in terms of coins, bars, jewelry, or whatever you want. And third is ETF, right? It will depend how you want to do it. The only difference when you invest in ETF is that it is a paper investment. You are not really having that yellow gold in your hands. So I think you can decide based on that. And if you're thinking that you will want that money as an investment, and after 5 years, 10 years, so you want to take that money, I think ETF that way suits better.
All right. So you're saying buy an ETF. It's the most efficient, provided I don't want to, buy jewelry out of it, yes, or use it over the next few years. You did say that make sure that you pick an ETF, and there are so many gold ETFs for us to choose from, based on the AUM, based on the spread or the margin or the tracking error that the ETF has. Given the options we have in the market right now, could you tell us, according to your research, which ones are the most efficient at this point?
So one is there are many ETFs available now, I think more than 10, 12, and almost all AMC companies, they have got the ETFs. So, and their returns are directly linked with the gold prices. So the chances in terms of returns being higher or lower are comparatively much lesser. Nevertheless, I think there are 3 ETFs where the AUM size is more than 1,000 crore rupees. So that makes them more liquid in terms of if you want to exit any point of time. So those you can look at. I think SBA has got more than this. Then this benchmark, Goldman Sachs benchmark has got more than this. So you can look at that, and I think they are fairly liquid in terms of getting in and out.
Gaurav, there is one more option for those of us who are looking to buy funds, because to buy a gold ETF, I have to have a demat account. And a lot of mutual fund investors don't have demat accounts. So then there's the gold fund. So what happens when I put 100 rupees in a gold fund is that it will invest in a gold ETF on my behalf. Is that a good way to go if I don't have a demat account? Or does it make sense to open the demat account and go into an ETF?
Yeah, one is that, yeah, obviously, if you don't have a demat account, you may want to consider that route. Another thing is that many times, if you want to do some kind of SIP, and in real life, what we've seen is people are not able to remain that disciplined. So if it's an ETF, you'll have to call your stockbroker every month, unless you're doing online trading or online buying and selling, number one. Number two, many times brokers, they're not too keen doing small size deals. So if you want to just keep purchasing gold worth 3,000 or 5,000 rupees, while they'll service you, but they aren't too excited about it. Now, if those are situations that you are in, then SIP into a gold fund of fund, which is like, which eventually goes into gold ETF, is a better option, because you will give away your 12 posted checks or NEFT instruction or whatever, and you will also have a situation whereby you get a regular statement instead of demat account. So if you're a small time investor, or if you're somebody who's not going to remain disciplined for whatever reason, either because of your work or it's just that nature or whatever, then you may want to get into an SIP through fund.
But we must remember the fact that if it's 1% on a gold ETF, then I'll be paying even more on a gold fund.
You'll end up paying more, because you will have that fund of that extra additional charge
How
on
much
that.
could it possibly be? Could you give us a number?
So it probably could be 0.25% to 0.5%, whatever it is. So there would be an incremental number. It's 0.25. It will be that incremental cost that you'll be paying. So it's a cost that you're paying for not remaining disciplined. That's a cost that you have to pay.
All right. Gaurav also talked to us about tax, about what happens if I buy physical gold and make a profit on it. What happens if I buy an ETF or a gold fund and make a profit on it?
So if it's a physical gold, and if you make a profit, the benefit of long-term capital gains, which is normally a lower rate, you get that benefit after 3 years, which means after purchasing, if you wait for 3 years and then if you sell, then you get that rate of long-term capital gains. Like, so less than 3 years, it's short-term. However, if it's a gold ETF or if it's a gold fund of fund, then after 1 year, you get that benefit of a long-term capital gains. That's number one. Number two, if you're really a big-time investor, physical gold is subject to wealth tax, while any of these gold ETF or gold fund of fund is not subject to wealth tax. So you will save huge amount of money on gold on wealth tax, because wealth tax is 1%. So you're paying 1% without encashing any profit.
If I were to start a fresh investment, whether long-term or short-term, or for someone's future, it makes sense to wait until all of these restrictions are removed?
I don't think you should wait for the restrictions, because we don't know when it will happen and whether it will happen or not. But the only thing is, if you really want to invest in gold, you start investing, because you can't time these policy decisions or prices. And if you're investing in a piecemeal manner in by way of SIP, it is fairly good, because you are not going to invest for a short period of time.
All right. I'm going to take one question from Gyan Shekhar Manoharan, who's written in. He wants to know if gold ETFs have security or custody charges to safeguard gold investments. So basically, he wants us to go over the charges in a gold ETF one more time. You did say it was 1%. Is there anything else he has to consider when he's investing in a gold ETF?
No, when he is investing in gold ETF, I think the cost is, I say 1%. In some cases, it may be a little lower also, because there is a little range, but it is closer to 1% for most of the ETFs. And he need not to bother about anything else other than this cost which is going to incur.
All right. Gaurav, there's also, there are some international funds that invest in gold mining companies. Is that an investment that you would recommend to any of our investors?
It's a little tough, because those funds have taken major beating in recent times, or major beating, and those are the ones who are investing in stocks of mining companies, number one, plus the rupee dollar parity. I mean, all those issues come up. So if you're looking at investment in gold as an asset class, you may not want to consider that. If you're looking at diversification across globe, mining, etc., you may want to consider, but take this fact that it's taken a major beating. I mean, the performances have gone down drastically.
All right. So unfortunately, we've run out of time on this segment. Gentlemen, thank you so much for joining us. Before we go into break, I'm going to give you a list of the funds that were mentioned on the show and their current NAV, and also take a look at the physical price of gold as it's trading this week. Come back on the other side and we're going to talk about tax. Don't go anywhere. Welcome back. You're watching Investors Guide in ET now. Thank you for staying with us. It's time for our tax section. We've brought in Suresh Surana to answer the questions you sent in on tax. Suresh, thank you so much for joining us. Interestingly enough, a lot of the questions we have are from NRIs this week. Kishore has written in. He tells us he just received a work transfer for the US. He's going to be living there and working there for the next 3 to 5 years. Kishore, I'm sure you're happy. Congratulations. He says he currently has SIPs and his home loan EMI going out of his residence savings account. He wants to know if he should change that to an NRI account or if there'll be any legal or tax implications if he doesn't do that right now. Suresh, what would you recommend he does?
Faye, in case of Mr. Kishore, he can continue to hold the SIP units. All that is required is that he has to intimate the depository about the change in his status. The second thing, as far as his home loan EMIs are concerned, also he can continue to pay. His bank account, once he becomes a non-resident, he will have to inform the bank to change it to non-resident ordinary account. And to that extent, the EMIs will then get charged to his NRO account on a regular basis. There is no really other prohibition or restriction on his continuing both the SIPs and the home loan.
Our next question is from Kirk Fonseca, who writes in. He tells us he's been paying taxes in India for the last 8 years. He now has an overseas job and he's going to move overseas. He wants to know if he's still going to need to file his returns in India every year and how should he be filing his returns?
Faye, in the case of Mr. Kirk, the obligation to file income tax return is applicable if his income in India exceeds rupees 2 lakhs, which is the minimum taxable limit, and that is before the deductions under Chapter 6A. For this purpose, whatever income he is earning outside India will not be included unless he remits it directly into India. The fact that he is having permanent account number is of no consequence. That does not mean that he has to file the return. So it is simply based on how much income does he have in India after becoming a non-resident.
We have a question from another NRI. Shekhar has written in. He tells us when he watched the show the last time, he realized that NRI fixed deposits are exempt from tax. He wants to know how that works. He also tells us that he's inherited property that now generates a rental income of 1.7 lakh rupees every year. He wants to know what sort of tax he's going to have to pay on that amount as well. Suresh, could you help him? Because he also wants to know how he's going to have to file those returns.
So, Faye, as far as Mr. Shekhar is concerned, whatever interest he is earning on NRE and FCNR deposits, that is completely exempted and it is not even to be counted for the purpose of the rupees 2 lakh basic exemption for income tax return filing obligation. Any interest which is earning on NRO deposits has to be considered. As far as the income from house property is concerned, which is 1.7 lakhs, he will be able to get 30% as a deduction towards the maintenance and repairs. So what he really needs to consider is what is his income on account of the rent and what is his income on the NRO deposits. If both these put together exceed the threshold limit of rupees 2 lakhs, only then he will be required to file the income tax return.
All right, so that's a wrap on the show. Suresh, thank you so much for answering our questions this week.
Thank you.
So if you have a question on gold, on tax, or anything else to do with your money, feel free to write to us. Our email ID is at the bottom of your screen. Remember, we are very partial to women investors. You can also find a copy of this show on our Facebook page, and you can reach me personally on Twitter. Thanks so much for watching.